Unit 42, Business Accounting. Unit Overview. Running a real estate brokerage requires books and records be kept using Generally Accepted Accounting Principles (GAAP). This unit discusses some basic accounting principles and terms. Unit Outline and Objectives. This unit covers the following topics: balance sheets, profit and loss statements, cash flow statements, explanatory notes, financial terms. After completing this unit, you will be able to define a balance sheet, explain the difference between current assets and non-current assets, define current liabilities versus non-current liabilities, explain shareholder equity, net worth, define working capital, and calculate asset test ratio, current ratio, debt to equity ratio, define a profit and loss statement, define a cash flow statement, and explanatory notes. Explain GAAP, EBITDA, cash accounting versus accrual accounting, personal property tax, and analyze a basic financial statement. Balance sheet. Balance sheet, a financial statement that reports a company's asset, liabilities, and shareholders' equity at a specific point in time. It provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. The asset of a company must balance be equal to the company's liabilities plus the shareholders' equity. Asset, the valuable resource of property rights owned by an individual or business. Current asset, cash or other items that can be turned into cash within 1 year. Assets that will be used up in the operation of the business within 1 year. These include cash, accounts receivable, inventory, and prepaid expense. Non-current assets, property or other assets that will last more than 1 year, such as real estate, plant and equipment, furniture and fixtures, leasehold improvements, computers, and intangible property. Liabilities, financial debts or obligations that arise during the course of business operation. Current liabilities, amounts owed that will be paid within 1 year. They include accounts payable, payroll taxes, and the current portion of long-term debt. Interest and dividends payable. Non-current liabilities, aka long-term debts, obligations that become due in more than 1 year. These include long-term loans on real estate or equipment and long-term lease obligation. Equity, aka shareholders' equity, net worth, or book value. The monetary value of a business which exceeds the claims or liens against it by others. It represents the amount of money that would be returned to the owner's shareholders if all of the assets were liquidated and all of the company's debt was paid off. Net worth equals total asset, total liabilities. Liabilities. What is XYZ when it gets net worth? Question mark. Working capital. The X is amount of current assets over current liabilities. How much working capital does XYZ Widgets company have? Asset test ratios, aka quick ratio, using the balance sheet. It indicates whether the business has sufficient short-term assets to cover its short-term liabilities. Formula: asset test ratio equals cash plus marketable securities plus account receivable slash current liabilities. The asset test ratio is one of the most important credit barometers used by lending institutions as it indicates the ability of a business to meet its current obligations. The asset test ratio should exceed 1. What is XYZ when it assesses asset test ratio? Current ratio, current asset plus current liabilities. It includes the value of inventories that have not yet been sold, so it is not the best evaluation of the current status of the business. The asset test ratio covering the most liquid or current of current assets provides a better evaluation. If the asset test ratio is much lower than the current ratio, it means that a company's current assets are highly dependent on inventory. Calculate XYZ index widgets current ratio, debt to equity ratio, DE, total liability, debt plus equity. A high DE ratio indicates that the business is highly leveraged. What is XYZ widgets? The debt to equity ratio. Here we have a balance sheet example. Shows assets, current assets, total assets, fixed assets, total assets, the liability, and total liabilities, and equities. True or false? A balance sheet includes assets, liabilities, and owner's equity. True or false? Correct answer is true. Current assets are items that can be liquidated within 1 year. True or false? The correct answer is true. Okay. Non-current assets are assets on which payments are in arrears. True or false? Correct answer is false. Current current liabilities are those that must be paid within 1 year. True or false? Correct answer is true. Non-current liabilities are also known as long-term debts. True or false? Correct answer is true. Shareholders' equity, net worth, and book value are all the same thing. True or false? Correct answer is true. Working capital is defined as current liabilities minus current assets. True or false? Correct answer is false. The total sum of cash plus marketable securities plus accounts receivable divided by current liabilities is the asset test ratio. True or false? Correct answer is true. The current ratio equals current assets divided by current liabilities. True or false? Correct answer is true. The debt-to-equity ratio is found by dividing total liabilities by the owner's equity. True or false? Correct answer is true. Okay. Profit and loss statements. Profit and loss statements, income statements, summarizes the revenues, cost and expense incurred during a specified period. Total revenue, the total of all income received by a business. Cost of goods, the direct cost of the production of the products sold. It includes the cost of materials used in manufacturing the product, along with the direct labor costs used to produce it. Gross profit, total revenue, cost of goods sold, expenses, the total of all operating expenses of the business. Net profit, gross profit, expenses. Cash flow statement, a statement of the actual movement of cash within a business. Explanatory notes. footnotes to financial statements, additional information that explains how a company arrived at its financial statement figures. They also help to explain any irregularities or proceeds in consistence in year-to-year accounting. Sorry guys if I don't read the words correctly. Financial terminology, GAAP, General Accepted Accounting Principles, the common set of standards for accounting in the USA. Earnings before interest, tax is depreciation and amortization, a measure of business performance that shows earnings without the influence of accounting and financial education. Accounting methods. Cash accounting enters revenue and expense when received and paid, typically used by small businesses and individuals. Accrual accounting enters income when the service has been provided or the goods shipped rather than when the business received payment. Expenses are accrued when they are incurred as opposed to when they are paid. Personal property tax, a tax on the fixtures, equipment, and furniture that a business owns. In Arizona, the country assessor values personal property through the cost approach to value. Here it shows a income statement example, just shows a marketing expense, advertising and promotion, general, and yeah. And right here it says net operating profit, pre-tax profit, net income. Basically, just showing a statement, income statement. Okay, we have a true and false. A profit and loss statement includes revenue, cost, and expense incurred within a specific time period. I know everyone's gonna laugh because I couldn't pronounce that word right, but it's okay. True or false? Correct answer is true. Footnotes. Footnotes to a financial statement help explain irregularities. True or false? Correct answer is true. Okay. EBITDA stands for earnings before interest, tax, depre- depreciation, and amortization. True or false? Correct answer is true. Excuse me. The accounting method that enters income, excuse me, when received is the Arcade method. True or false? Correct answer is false. Key terms. The following are key terms for this lesson. Accrual accounting enters income when the service has been provided or the goods shipped rather than when the business received payment. Expenses are accrued when they are incurred as opposed to when they are paid. Asset test ratios, quick ratios, using the balance sheet. It indicates whether the business has sufficient short-term assets to cover its short-term liabilities. Assets: the valuable resource or property rights owned by an individual or business. Balance sheet: a financial statement that reports a company's assets, liabilities, and shareholders' equity at a specific point in time. Cash accounting enters revenue and expense when received and paid, typically used by small businesses and individuals. Cash flow statement: a statement of the actual movement of cash within a business. Cost of goods: the direct cost of the production of the products sold. It includes the cost of materials used in manufacturing the product along with the direct labor cost used to produce them. Current assets: cash or other items that can be turned into cash within 1 year, and assets that will be used up in the operation of the business within 1 year. These include cash, accounts receivable, inventory, and prepaid expense. Current current liability: amount owed that will be paid within 1 year. They include accounts payable, payroll, taxes, and the current portion of long-term debt, interest, and divid- dividends payable. Current ratios: current assets, current liabilities. Debt to equity ratio (DE), total liabilities equity. Honestly, I think we already did this one. I'm gonna go ahead and skip this. Okay, unit summary. Before moving on to the unit quiz, please review these key points. A balance A balance sheet is a financial statement that reports a company assets, liabilities, and shareholders' equity at a specific point in time. Current assets are cash or other items that can be turned into cash within 1 year, and assets that will be used up in the operation of the business within 1 year. Non-current assets are property or other assets that will last more than 1 year. Current liabilities are amount owed that will be paid within 1 year. Non-current liabilities, aka long-term debts, are obligations that become due in more than 1 year. Equity, aka shareholders' equity, net worth, or book value, is the value of a business that exceeds the claims or liens against it. Net worth equals total assets, total liabilities. Working capital is the excess amount of current assets over current liabilities. The asset test ratio, aka quick ratio, indicates whether the business has sufficient short-term assets to cover its short-term liabilities. The asset test ratio indicates the ability of a business to meet its current obligations and should exceed 1. Asset test ratio equals cash plus marketable securities plus accounts receivable divided by current liabilities. Current ratios equals current assets, current liabilities. Debt to equity ratios DE equals total liabilities and equity. A high DE ratio indicates that the business is highly leveraged. A profit and loss statement income income statement summarizes the revenue, costs, and expense incurred during a specified period. Total revenue is the total of all income received by a business. Cost of goods is the direct cost of the production of the product sold. Gross profit equals total revenue minus cost of goods sold. Net profit equals gross profit minus expense. A cash flow statement is a statement of the actual movement of cash within a business. Explanatory notes, footnotes to financial statements are additional information that explains how a company arrived at its financial statement figures. General accepted accounting principles are the common standards for accounting in the USA. Earnings before interest, taxes, depreciation, and amortization, a measure of business performance that shows earnings without the influence of accounting and financial dedication. Cash accounting enters revenue and expense when received and paid. Accrual accounting enters income when the service has been provided or the goods shipped rather than when the business receives payments. Personal property tax is tax on the fixtures, equipment, and furniture that a business owns. Number one, which is a distribution of earnings paid to stockholders. Correct answer is C. Number two, in business accounting, earnings before interest, tax, depreciation, and amortization is often used to determine. Correct answer is A purchase sales price. Number three, a balance sheet indicates. Correct answer is A financial conditions of a company as of a certain day. Number four, which of the following is the best example of a direct cost? The correct answer is D payroll. When analyzing the financial statements of a company using current ratio and asset test ratio, what would you expect the satisfactor minimum to be on the quick or asset test ratio? The correct answer is D. Number six. The assets of a business are the. B. Items of value owned by the business. Number seven. Excuse me. When a buyer of a business reviews a balance sheet, it would show. B. Net worth. Number 8. Which of the following is an asset of a real estate brokerage? The correct answer is B. Building owned by the brokerage. Number 9. The accounting method in which income and expense are reported in the year they are received or paid is. Correct answer is A. Cash. Number 10. In terms of short-term solvency, the most meaningful ratio would be D. Acid test. Number 11. Which of the following is not related to business accounting? Would be C. Debt coverage ratio. Number 12. Recurring variable expenses include D. All of these. The net worth of a corporation is D. The total asset less the total liabilities. Bless you. Number 14. Which of the following items is not to be found in or determined from the balance sheet of a corporation? The correct answer is C. Net income. Number 15. Which does not appear on a balance sheet? The correct answer is D. Net income. An item not found in the income statement of a firm is would be A. Capital equipment. Number 17. A current liability is A. Net week's payroll. 18. Financial statements fall into two categories. They are balance sheet and income statement. Number 19. Assets equal liabilities plus stockholders' equity is found in A. Balance sheet. Number 20. Working capital refers to the A. Amount by which a corporation current assets exceed current liabilities.